We're here to break things down. RBC Capital Markets analyst Nick Modi, he's got a hold rating and a $165 price target on the name. What are your takeaways, Nick, from the management commentary about the significant cost headwinds that they're facing, the slowdown in volumes that they're seeing, and the consumer?
Yeah, I mean, look, P&G has faced a pretty challenging last few years, but they've managed to do reasonably well, at least relative to their peer group. Cost headwinds are moderating. I mean, they're actually expecting commodity cost to be a tailwind next year, though currency will be slightly an offset. As it relates to the consumer, look, whether we go into a recession or not, I don't really think it matters. The reality is consumers are changing the way they're behaving. We're seeing consumers trading down in certain categories. We're seeing them buy smaller pack sizes. We're seeing them shop at Dollar Channel and, share gains at Walmart, which, obviously consumers that are under pressure tend to look at Walmart to save money and have more value. So all of that is going on. But I would have to say, look, even though we haven't hold on this company, I think P&G is showing that it is a best-in-class operator in this industry, and that's as a result of 10 years of very heavy lifting that the company has done.
Your assumption is that P&G will sort of settle out in terms of market share, and that's sort of your assumption in terms of all the growth forecasts that you have. And I'm wondering, Nick, if there's a risk in your mind. I mean, if consumers are trading down and trying other brands, if you lose some of those consumers, or if it is always that when the consumer has that money, they'll go back to the premium brands.
It really depends, Melissa. So the one thing P&G did that was very smart is they started value messaging about a year and some change ago. What does that mean? They were basically showing, hey, it takes one Bounty versus 10 papers of private label as an example, right? So in the minds of the consumer, they're starting to then say, oh, wait, I'm okay paying extra money because I'm actually going to have to use less when I have to wipe my table, right? And so they were very smart about getting that value messaging out. And I think that's one of the reasons why they're still gaining share at a time where private label is actually gaining across many categories.
Nick, we also heard from Colgate. I'm just curious. Stock's down about 3.5%. I think you cover it as well. I think you're neutral on it. But just give me a take. I mean, this hasn't done much of anything for the last at least 3 years.
Yeah, look, I like the changes that they're making, but the reality is North America is under pressure. They made a big bet on whitening for this year, and that's a premium, more discretionary type product. So that's probably putting some pressure on their business. And the reality is, look, investor expectations were high coming into the print. Numbers were already at the high end of guidance. Now, Colgate actually raised their guidance today, but they effectively went to where the street was already. So part of this is really about just expectations were high going into the earnings call.
Nick, one last question in terms of Procter & Gamble. I know you think it's, it deserves a premium because of the execution, but it's trading, at 24. It's below the 5-year average in terms of forward PEs, but still, I mean, if you take a look more broadly across the market, it's trading at the same multiple as a Meta. And I'm just curious, how do you sort of walk through this valuation to your investors?
Yeah, for us, it's really about the consistency. If you go back and look at what really drives a consumer staples valuation, it's not really the magnitude of the growth. It is actually the consistency of the growth, right? Because if you think about it, why would a chief investment officer of any large fund buy a consumer staples company? It's really because it's their insurance policy in their portfolio, right? If they want growth, they can go to Meta or any other stock that you were mentioning. The reality is P&G has been very, very consistent, and that is partly why the multiple is where it is. So if you think about like long-term cash flow valuations, the duration and durability of what they're doing, I think, is much longer than some of its peers, and maybe even some tech companies, right, where you have obsolescence risk and a lot of volatility based on product cycles. So that's the beauty of consumer staples, right, is that if you can find the right stocks that can deliver consistent results, that will then warrant a premium valuation.